Another stock that disappointed, Marvell, was down 20% the day after earnings. They beat on almost every metric. I've got them in front of me. I'm seeing like 15 metrics that Wall Street tracks. They had missed on one, which was enterprise networking, very small part of their business. But generally, they only beat by 0 to 2% law of areas, and they're down. So the question is, why are they down so much when they beat on almost every metric? Well, in the case of Marvell, there's expected to be a massive ramp up in a relationship that they have with Amazon. So a lot of people were crowding into it, expecting a very large beat. Now we got something different than that. Instead, there's a smaller beat, but the company actually announced that they had won a contract for a next generation chip. A lot of people expected them to lose Amazon's next chip. So what you had is you had uncertainty declining, but the near-term estimate not being by as much, right? And what I think is going on is the next chip, which is Trainium 3, they're actually going to do a Trainium 2 Ultra. And with Marvell, they've actually struck agreements to do a whole host of custom chips with Amazon. So they're not just living and dying whether or not they're winning the next contract. David, what's really interesting is in the wake of these earnings, estimates for Marvell have actually increased, but the narrative is the worst that's ever been. So now they're at about 23 times next year's Wall Street estimates with 42% growth expected, 18 times the year after with 22%. The bottom line, David, is just, once again, how investors are looking at things has changed from recently. I think people piled into Marvell hoping for a beat, and then, they would be able to decide if they want to get in or out of the company. That's not thinking about things in the long term necessarily. If we're comparing Marvell to Broadcom, which we'll discuss next, why are we in Marvell as one of the portfolio holdings? Well, they're not a good company historically. If you look at their stock chart, they have disappointed, but they are about 1/10 the size of Broadcom, actually less now. And they have two very good relationships. One with Amazon that, as we noted, there's actually been some de-risking in that relationship, and another developing one with Microsoft. Broadcom is seeing their gains because, well, they're 10 times larger. They have three good relationships with these custom chips they're making, with a potential for 4 more they announced on their most recent earnings call. So again, this is a higher risk idea, but potentially higher reward relative, which is why we size Broadcom higher and why it pays attention to kind of the allocations we're putting behind all these ideas. But I wanted to bring this company up, David, because I think in a way the company's better off than it was a month ago, worth significantly less, right? And it's because they took some uncertainty out of the picture, but they didn't beat as much in the near term. If you're a long-term investor, that's a trade-off you're happy to make, but I don't think most of the investor base in Marvell was too concerned with this long-term picture. Finally,
just a quick question on Marvell. When you have a company like Marvell who just reports earnings, that you say, in your mind, positive commentary. Mm-hmm. Now we have to wait several months before they get their next earnings. In the time in between, is it kind of just like, we don't know what's going to happen with the market. It might go down another 20%. Is it really just waiting that we got to check in at the next quarter and that's the next catalyst for this type of company? Is that the cadence of information on a company like Marvell?
I think so. And, I'm sure because we are fully allocated, there is some question. I really think something like a Taiwan Semiconductor trades out at outstanding value today. Do you just want to sell some Marvell and put into Taiwan Semiconductor? I could definitely understand some people making that move, but it's as I noted, it's just really hard to know how these catalysts change. With Marvell, it's unclear when you might see a ramping with that Microsoft business. So you might get out before there's a catalyst that happens. There's a very small company named Applied Optoelectronics. We've talked about its ticker symbol AAOI. We haven't had the portfolio because it is beyond a credo risk profile. It had jumped from $6 to $40 pretty quickly. In the sell-off, it had gone back to $15. One of the catalysts that I had was it had been promising some new major partnerships. Just yesterday, they announced a massive partnership with Amazon. I believe their Amazon. Sorry, one second. I'm pulling them up right now. Amazon had offered or put in a commitment to purchase potentially up to $4 billion worth of their products. The company's sales this year are supposed to be 500 million, and its stock's up 41%. So if you had sold this stock in the meantime, you're not getting the fruits of that next unknown, because you had ran out of that patience, and there's no way to know when some of these announcements happen. So if we believe and we have our overriding thesis that Marvell is an unloved stock today for the reasons that we've talked about, but we believe its relationship with Amazon is stronger in many ways than it was 4 months ago, and we still have the coming catalysts of things like a relationship with Microsoft and the position that we like in some of its areas, how it has a lot of business for other parts of its data center business. I don't think right now is the proper time to reallocate. So you got to take your lumps. One thing I've been asked is, do you want to do hedges in your portfolio? And man, it sounds so sexy, right? It's like, oh, you're able to, put this in as your bearish, but I would have been pretty bearish at the start of 2024. And there's times in 2023, I would have been bearish. And every single time I would have been paying for that protection. And every single time, and when they work, there's often tax implications because it's a lot of short-term gains. So sometimes it sounds better than the reality is. And I don't, if people want to use kind of protection against, these portfolio swings, I don't blame anyone for doing it. And some people are very good at, but if my belief is that we are taking a percentage of our portfolio to be an allocation to a mega trend like this, you just have to think in those 3 to 5 year time frames, right? Which is what we're trying to do.
Yeah, well, it's wild to hear you say Marvell is an unloved stock right now. At the beginning of literally 2.5 months ago at the start of the year, that was on the top of many people's list of kind of the number one stock for 2025. Marvell, huge. If you missed Nvidia, Marvell is a play. So very interesting to see that attitude shift. But again, that's usually when it's more interesting, is when people are out on it. It's given back a lot of the gains that it had last year.